Okay, let's get into this. Today, we're attempting something a bit different, maybe a feat of intellectual acrobatics. We're going to try and connect sectors that, well, on the surface, seem to have almost nothing in common. We're talking AI's, frankly, dizzying spending spree, the gritty reality of commodities like coal, the complex geopolitics of nuclear fuel, even tungsten, and then the pristine aspirational pricing of luxury goods. Got a stack of sources here, quite a big one, that actually link all of these. Our mission in this deep dive is really to see them through one specific, powerful lens, the capital cycle. And the core idea that just jumps out from this material is that while these diverse sectors are all swinging between that classic excess optimism and the inevitable hangover of investment arithmetic, this time the cycle seems guided less by pure animal spirits and much more by two specific forces: deliberate government policy decisions and, frankly, fundamental scarcity.
That really is the critical shift, isn't it? If you're tracking where serious global capital is moving today, you can't just follow the market buzz. You have to follow the policy levers and the hard limits of physical reality. So we're going to examine this investment landscape through that lens, focusing on strategic assets, policy drivers, basically helping you understand the common thread between, say, the hyper-digital world of AI and the essential foundational world of critical minerals and energy.
Right. Let's dive straight into the epicenter of maybe excess optimism right now.
Yeah.
The AI investment capital cycle. Numbers we're seeing here are just staggering. We really need to unpack this CapEx boom planned for 2025 to 2028. Our sources, looking at estimates from firms like Morgan Stanley, McKinsey, they show the big hyperscalers, Amazon, Microsoft, Google planning to spend somewhere between, $3 trillion, potentially up to $5 trillion globally.
Yeah.
Just a few years.
That $5 trillion figure, if it actually happens, it's almost unfathomable in historical investment terms. And what's truly fascinating, or maybe terrifying, is the financial math you need to even begin to justify it. You don't just build these massive, incredibly complex data centers on a whim, right? To make the economics work at that scale, the industry needs to generate something like $500 billion in annual net cash flow.
Hold on. $500 billion in cash flow
Yeah.
every single year.
Yeah.
Sounds less like forecasting and more like a massive bet. What kind of revenue number sits behind that cash flow target?
Precisely. I mean, if we assume a, let's say, reasonably ambitious 20% free cash flow margins, or 20 cents of every revenue dollar becomes actual usable cash, that implies the industry collectively needs to hit roughly $2.5 trillion in annual revenue. That's the kind of hurdle they have to clear to make that $5 trillion CapEx spend look profitable down the line.
But hang on a second. A 20% free cash flow margin. In a brand new, fiercely competitive market where everyone is sinking trillions into basically the same kind of infrastructure, that seems wildly optimistic.
Yeah.
What stops that margin getting crushed immediately?
And you've hit the absolute core dilemma. One of the sources put it perfectly. It's the tech version of the prisoner's dilemma. Everyone has to spend the money, the $5 trillion, because the risk of not spending is potentially being locked out of the next big technological wave completely.
Yeah.
But once those assets, those enormous data centers are actually built, they become high fixed cost, low marginal cost operations.
It means the second they're up and running, the incentive is just huge to undercut everyone else on price, to fill capacity, right? Pushing prices down towards that very low marginal cost.
It's an almost inevitable cycle. Deflationary pricing pressure slamming up against immense capital debt. Now, just to give you some context on the sheer scale, compare that needed $2.5 trillion revenue goal to where a current leader is today, OpenAI. Their current run rate is around $13 billion.
$13 billion versus a required $2.5 trillion.
Wow. The gap between today's reality and the required future profitability for this CapEx boom is just vast. It points to a profound, almost necessary level of collective industry optimism.
And if we zoom out a bit, this AI CapEx spend between 2025 and 2028, it's a macro event in itself, isn't it? You mentioned comparisons to global benchmarks earlier.
Yeah, absolutely. This level of spending, it approaches something like 10% of U.S. GDP over that period. And it represents maybe 5% of global labor costs. We are genuinely talking about a capital cycle that dwarfs almost any non-war-related industrial expansion in recent memory.
So the crucial takeaway for listeners right now.
It's simple, really. While the AI narrative is incredibly compelling, you absolutely have to watch for CapEx fatigue incoming and watch for the inevitable margin risk that are going to materialize when supply eventually catches up to demand and that deflationary pressure really starts to bite.
Okay, that's a powerful transition because we swing hard now from that speculative digital future spending to the really foundational industrial reality of today, which brings us squarely to commodities, and specifically these structural shifts highlighted in what the sources are calling the McKinsey reversal. and their commodities outlook to 2035. We've had maybe a decade of strong ESG narratives, aspiration-driven investing. So what specific reversal did McKinsey publish that signals such a, well, profound shift in industrial reality?
Well, the shift is frankly monumental because it hits the cheapest, most reliable form of bulk global energy, coal. Just a few years back, driven by widespread ESG optimism and policy targets, coal demand by 2035 was forecast to be down, significantly down, maybe 40%. The recent revision, it's an almost complete U-turn, an acknowledgement of industrial necessity. That forecast has been walked back entirely, and coal demand is now projected to be up 1% by 2035.
Up 1%, not just flat, but up. That is a huge policy pivot, isn't it? It's a clear signal that global industrial reality baseline energy needs. They're setting the price and the policy direction now, kind of overriding the previous aspirations. What's driving that relentless demand?
It's driven by the simple fact that much of the world is still industrializing, not just decarbonizing. The sources really highlight this concept of the emerging developed markets convergence. Historically, we saw emerging markets as sort of secondary demand drivers, but today, they are essentially the primary engines of global demand growth. They need massive amounts of steel, cement, and yes, coal power to build out infrastructure, power grids.
So the whole idea of emerging markets is becoming a bit obsolete. They're now integrated industrial powerhouses whose growth demands real physical materials.
Exactly. As some of the Amundi research points out, supply chains, capital flows, commodity use,
Yeah.
it's all becoming functionally indistinguishable between the old developed camp and these massive converging markets. And this convergence means the old rules, like a downturn in the West, automatically leading to global commodity softness, that just don't hold anymore.
Right. And the implication then for strategic autonomy must be enormous. If demand is relentless and global, supply chains are tight. Then policy, not just market mechanics, starts to really shape the commodity price cycle for the next 5 years or so, 2025 to 2030.
That's it precisely. Governments worldwide, particularly in the West, are now looking at secure access to energy transition commodities, lithium, copper, nickel, and yes, even things like tungsten as absolutely vital national security priorities. Structurally, these are becoming the new defense stocks. It's not about maximizing next quarter's return. It's about maintaining an industrial base, securing a long-term competitive edge.
That structural reality leads us perfectly into specific strategic assets. Let's start with the nuclear renaissance. This isn't just about clean energy anymore, is it? It feels like a really potent policy-leveraged growth story because it directly tackles that looming threat of power scarcity. What are we seeing in terms of actual hard investment?
Well, we're seeing the first really meaningful domestic U.S. investment in nuclear conversion facilities since the 1950s. That's huge, and it's driven by this incredible alignment you rarely see. The Department of Energy, Congress, Wall Street, they're all basically pointing in the same direction on energy sovereignty and national security. The whole uranium mining investment thesis today is fundamentally driven by this top-down macro imperative.
And the market's clearly reacting. Uranium prices up above $100 a pound. That's not just market noise, it's reflecting this policy consensus, surely.
Indeed. It reflects this core idea that power scarcity, reliable power, is now the new geopolitical currency. The ability to guarantee cheap, continuous, domestically sourced energy is a massive national asset, and rebuilding the full nuclear fuel cycle is essential for that. You know, in the language of one of our sources, they call it Nutstuff terms, which is interesting. Uranium has basically graduated. It's moved from being a pure narrative play where you invest hoping something happens to becoming verifiable infrastructure, where you invest based on real government contract guarantees and solid long-term utility planning.
That makes a lot of sense. Nuclear is the ultimate long-duration infrastructure play. Okay, now let's pivot to something maybe less well-known. Tungsten. The sources call it the quiet critical metal. Why are we suddenly talking about this relatively obscure metal in the same breath as trillion-dollar AI spends in nuclear sovereignty?
It comes down to one word: vulnerability. China controls over 80%, maybe more, of world tungsten production. For the Western industrial base, the supply chain vulnerability for this specific metal is, well, it's absolute. We cannot easily substitute it in many key applications.
Okay, so if the world needs it, China controls most of it. Why is it so indispensable? What does tungsten actually do?
Tungsten is basically the bedrock of strategic metals machining and drilling. It's essential because of its extreme hardness and incredibly high melting point. Think about any critical industrial process involving precise, high-speed cutting or drilling, defense production, complex aerospace components, high-efficiency auto manufacturing, even deep oil and gas drilling. Tungsten carbide tooling sits behind almost all of that advanced capability.
So it's like the unsexy, super hard glue holding the advanced manufacturing base together. If the AI future needs advanced chips, those chips need advanced machines, and those machines rely on tungsten tooling somewhere down the line.
You got it. It sits right at the fault line of these growing commodities, trade wars, and critical minerals manufacturing policy. And this scarcity, coupled with the geopolitical leverage, creates very specific, though maybe niche, tungsten investment opportunities. The sources even mention specific companies like Tungsten West for UK investors, just highlighting that sometimes small cap plays in these critical metals can offer quite outsized geopolitical leverage.
Okay, right. We definitely need a mental palate cleanser after talking about half-trillion-dollar debts and the absolute criticality of defense metals. Let's look at maybe the only consumer sector that seems almost immune to these brutal capital cycles: luxury goods. Why are high-end brands like Hermes and Moncler even relevant to this whole capital cycle discussion?
Because they fundamentally act against the typical norms of the capital cycle. They display this incredibly rare thing, true luxury brand pricing power. And they achieve it by deliberately preserving their brand equity. How? By refusing the temptation of volume growth. They almost never discount. They fiercely guard against any kind of brand dilution. They are explicitly not chasing the cyclical growth that basically every other consumer company on earth aims for.
The sources use some fantastic analogies here to describe this. Hermes is called the Swiss franc of luxury. What does that capture?
Yes, that analogy is brilliant because it perfectly captures scarcity and stability. The Swiss franc is seen as a global safe haven currency, right? Hermes, in this view, is the safe haven for capital chasing status. It's scarce, it's perceived as asset-backed, or at least status-backed, and it seems remarkably recession-proof because its core customer base isn't really affected by minor economic bumps.
And Moncler gets framed as the sovereign wealth fund of style.
Which implies discipline, strategic patience. Sovereign wealth funds, ideally, compound quietly. They acquire assets strategically over the long term. Moncler has kind of done the same in the apparel space, maintaining profitability, expanding margins, even while nearly everyone else in apparel is forced into these endless discounting wars just to move product and chase volume.
So if we look at their stock valuations, they often look completely absurd compared to standard growth companies, right?
And that's the key valuation insight. They aren't acting like typical growth equities. They're acting more like currencies or perhaps hard assets. Think about it. While the AI hyperscalers are spending trillions, potentially only to see their free cash flow margins collapse into single digits due to brutal competition. Hermes and Moncler are continually expanding their margins by meticulously preserving status and desirability. They capitalize on aspiration, which, unlike data centers or coal seams, is infinitely renewable and fundamentally non-dilutive.
So what does this all mean when we try and put these very different pieces together? We've looked at 6, frankly, disparate sectors: AI's potential financial trap, the hard industrial reality of coal, strategic metals like uranium and tungsten, the unique pricing power of luxury. But the common thread seems pretty clear now. The capital cycle is definitely back, but it feels like it's being firmly guided by policy, by fundamental scarcity, and by industrial reality, maybe less so by just speculative enthusiasm alone this time around.
Yeah, the synthesis is quite powerful when you see it laid out. AI's massive marginal cost trap. It really does mirror things like the great 19th century railroad booms, huge capex followed by intense competition and shrinking returns. The commodities outlook 2035 shift, that reflects gritty industrial realism triumphing after years of maybe ESG theater or aspiration. Nuclear and tungsten, they're now clearly state-backed necessities driven by strategic scarcity concerns. And luxury, it remains the singular consumer sector that behaves much more like a hard asset, insulating itself remarkably well from typical cyclical pressures.
So, for listeners, success seems to lie in spotting those intersection points where government policy, actual capital flows, and real physical scarcity converge. We saw the importance of that emerging developed markets convergence driving relentless commodity demand. And the sources warn pretty clearly that benchmark changes are coming. That suggests investment portfolios might need to be completely rewritten to reflect this new reality. A reality where China and the broader converging world are setting industrial demand patterns, and the West is increasingly prioritizing strategic autonomy over pure market efficiency.
And that really raises an important final question, maybe a provocative thought for you, the listener, to really mull over. If power scarcity, reliable, affordable energy is now fundamentally the new geopolitical currency, the defining factor for both economic prosperity and national security. How does that shift your entire definition of risk when you make investment decisions across all 6 of these very different sectors going forward?
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.